12th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from about as stereotypical of a winter day as we get here in Redmond, Washington. I actually live just outside of Redmond, out in the woods, out in the countryside, up in the hills. And man, we had some vicious wind. Wind is actually not super common around here. And we've got a lot of huge trees, and that can cause some issues. Thankfully, Keller family all in good shape. Half the schools in our area were out today because they lost power. But hey, we're hanging in there and doing the best we can. Hope you guys are all staying safe wherever you're at, whatever you're facing, natural or otherwise. Speaking of markets in ugly conditions, markets are in ugly conditions today here. Very much a risk-off day. Yesterday, going into the close, we had a bit of a bounce higher, and it's always sort of back of my mind as we have a last 30 minutes rotating higher, because that's how Wednesday finished. And honestly, when the afternoon kind of finishes strong, that implies kind of institutional buying at the end. So I remember thinking, ooh, I wonder if we get like an up day maybe after that. Was not to be. We opened weaker and we stayed weaker. And I think that is one of the most important messages we'll talk about in today's episode, right? Starting weak, getting weaker. That's not great. So today we're going to talk about the market conditions here. We're going to look at the charts. We will start with a recap of the major market conditions. Here on Stock Charts, we're going to go to the heat map, and a lot of red unless you're the energy sector, but we'll see that here in a moment. And we'll finish with some charts that I've hand selected to review. Hopefully, a little educational, highlighting some of the key technical ways that I think you can make sense of the markets in these conditions. The conditions that we've been talking about as they evolve, weaker breadth, all of that continuing here. By the way, you might have seen the little banner running below the introduction here. We've got a webcast coming up next Thursday, March 19th. I'll talk to you about that in a little bit. That's a free webcast, and I hope you'll join me for that one. All right, here's what the S&P looked like. And again, today we opened weak and we got weaker. When you have a weaker open like this, the question is, do you see buyers coming in? Is that just like an overnight thing? We're digesting overnight news and then a bunch of accumulation happens. That is not the vibe we got today. And a lot of days, actually, recently, we've often seen a bit of a shift. Midday, sort of like morning to lunchtime is kind of one market, and then lunchtime to the close ends up being kind of different. That's not unusual because the volume usually is super dry in the middle, right? A lot of the volume in the beginning of the day, a lot of volume at the end of the day. It's kind of quiet around lunchtime. So if you look at the daily volume reading, it's kind of like a smile or a U shape. That's pretty normal because of the nature of how people are trading, and a lot of institutions save any of their good stuff for the end of the day, any of their big positions. Having said that, that weaker afternoon today now has me feeling not so great about market conditions. Today's drop was enough to push the S&P down 1.5%. We closed just above 66.72. So we are well below our initial line in the sand of 6,800. We are still above our kind of big time line in the sand of 65.50. But boy, that level appears to be getting closer and closer out of the dashboard here, right? Looking at the front of the airplane, I'm seeing 65.50 coming in hot directly in front of us. So we'll see how this plays out. Mid caps and small caps both weaker, and to be honest with you, between the Dow, the S&P, the Nasdaq, mid cap and small caps, I mean, it was generally kind of a large over small day, but still everything was down in the 1.5% to 2% range. Given the fact that the VIX has been above 20. Remember yesterday, I was telling you, I think it was yesterday, we had kind of a small percentage move. And I said, listen, the VIX is so high. What happened today is pretty unusual. The market's pricing in bigger swings. Today, what we saw today is what the VIX being above 20, with the VIX around 27 after today's action. That's what that high VIX represents, right? It's an expectation that the market is pricing in terms of the daily percentage swings. And that's why it's a volatility based index. VIX pushing higher as the S&P and the Nasdaq are going lower. That basically says increased fear, increased uncertainty. That's usually not the environment where the market rallies. That's usually more of a corrective period. And we're seeing that pullback continue to play out here. Looking at interest rates, we can see the 10-year Treasury yield pushing higher. It's kind of got back to unchanged in the afternoon, but bonds sold off going into the close. So the TLT, which is a bond price ETF, finished down just about 0.25%. but all the rates that we're tracking here accelerated to the upside. The 10-year Treasury yield finished above 4.25, which is, kind of pushing to a new swing high here. We're getting to some of the higher levels that we've experienced in recent months here. The long bond yield is just below 4.9%. So we're definitely seeing rates, going higher. We talked earlier this week about what that move higher in rates really means, given what we're seeing here, given the fact that, real measures of inflation, right? Measures of pricing in the form of like crude oil and raw materials, those things are all going up pretty big time this week and certainly this month. And so what that implies is that prices are going to be higher for other things, right? Because you use oil to move stuff around the world. You use, wheat and soybeans and all those things to make food. And so all the stuff to make stuff is getting more expensive. That's my 101 version of what we're seeing here in terms of inflationary pressures. So prices are going to go higher as a result. Rates are basically going up in an expectation of higher inflation here as the year progresses. Market now pricing in one rate cut for 2026, as we mentioned earlier. Dollar index, by the way, up another 0.5%. That swing in the dollar also related to what we're seeing in the Middle East and pressures upside on the dollar. Stronger dollar is the opposite of what we observed for quite some time here. Looking at the commodity space, obviously the big story remains crude oil. This is, obviously a very active situation in the Middle East. I feel like every day is bringing new headlines, new speculations, new comments, just sort of trying to get our head around the implications of this. If you're not picking up on this, it is very hard to get a read on what the impact may be. A lot of people I've talked to, and even last week I interviewed George Noble, famous mutual fund investor, hedge fund investor. I interviewed Lindsay Bell of 248 Ventures. She's a fantastic market strategist. And, they echoed what I would say is kind of the general way you think of something like this. The impact is usually pretty minimal until and unless you start to see, companies talking about how it's going to impact their earnings. And I think that's what the market is starting to do, is thinking, okay, if the Strait of Hormuz is kind of shut down or very close to that, or if companies are not sort of using that the way that they did, all of a sudden that means less oil is moving around. All of a sudden that means fertilizer, which is the one I was reading about earlier this week. A lot of fertilizer comes through there, which means food prices may be going up if fertilizer becomes more expensive. There are all these ripple effects. And what you have to remember is the stock market is a forward-looking mechanism. I had a really fun interview earlier today for the podcast with Alex Carteau. Alex is a co-founder of a company called EPS Momentum. It's a really cool new platform that looks at price momentum and earnings momentum. So we talked a lot about that price to earnings relationship. And what he was reminding me is that, the market trades on earnings estimates, on expectations for future earnings, months, quarters, even years down the road. And so everyone's trying to put on their, what are the ripple effects? What are like a couple moves later on the chessboard? And what does that mean about whether a particular company is going to be able to grow through this period or struggle? And so higher crude oil prices are happening. Higher natural gas and other gas-related products are happening. We highlighted yesterday the strength in some of the soft commodities like corn and soybeans. What is not strong today, gold, silver, the GLD, the SLV, all down today, as were copper prices. So the chart of gold, again, I would say is still okay. It's still good. Is it making new highs? It is not. And what we've seen now is the volatility in gold has expanded quite a bit. The choppiness of gold is very real. We're now down toward the lower end of the range that we've been here over the last month or so. A breakdown below key levels could be pretty significant, but we're still kind of holding ground there in gold and in silver, two of probably the strongest charts over the last 12 months. But the strength in energy, very much there. The energy sector continues to be a bright spot in a challenging period for the equity markets, and we'll see that as we get to the heat map for sure. Finally, cryptocurrencies. Bitcoin, choppy, sloppy, sideways, basically flat for the day. Bitcoin's currently just around 70,350. Ether prices for now holding that 2,000 level, which is a big round number that we tend to focus in on. Kind of choppy during the equity trading session overall. All right, looking at the 11 S&P sectors, I mean, similar to what we've been describing here in recent sessions, I think one of the biggest shifts we've observed, from January and February now into March, right? A lot of what my process is focusing on what's different, focusing on what changes, on what's new, because you don't want to get complacent and just assume that whatever has been happening keeps happening, because at some point things change. And so recognizing what we call a change of character, I think, is the game for investors. The biggest shift that we've observed here is the fact that breadth is starting to get really ugly. We can see that again today with only two of the 11 S&P sectors finishing in the green. That's energy and utilities. Energy up 0.9%, and utilities, the XLU, second from the top, up 0.7%. The rest of the 11 S&P sectors were all down. Industrials getting dinged the biggest, down 2.5%. Some of those big aerospace and defense names had a pretty sizable pullback today, as we'll see here in a moment. I did grab at least one of those charts, I think, to talk about. It's a blur because I was seeing a lot of charts I wanted to talk about. So I had to. What often happens is you're doing, for me, I have like 50 charts and we only have time for a handful. So I have to start trimming them. So I forget which ones I saved and which ones I didn't. But I'm pretty sure I grabbed at least an aerospace name or an industrial name for sure. Consumer discretionary down 2.3%. This has been, I mean, the consumer sectors generally have not been particularly strong. But what's noticeable here is here's the XLY down 2.3%. Consumer staples, which have often been struggling, only down 0.4%. As you'll see in a minute, the big box retailers actually had a pretty okay day, and a number of them were actually up, while the benchmarks were down and a lot of individual stocks were down. So consumer discretionary feeling the pain today. Technology down 1.8%, as was healthcare. This was a bloodbath of sorts in terms of the action on the S&P, as we'll see here. Looking at the individual stock breadth, right? The classic market breadth indicators, all pretty negative as well to varying degrees. On the New York Composite Index, almost an 80% down day, which is pretty significant of a distribution period. 79% down, only 20% higher. On the S&P mid cap, over 80% stocks were down. Pretty consistent breadth, right, across different cap tiers. It's not like small caps were a lot better than large caps in this case. This is sort of an everything down type of day. What's interesting, though, and I always like to remind people, is when you look at this and you think, oh, this is really bearish. And you're right, at a high level, it kind of is. But hey, 1 in 5 New York Stock Exchange listings were up, right? 22% of the S&P were up. And that doesn't mean that most things weren't down. They were, but that means about 100 some names, 104 names out of 500 were up. So let's focus on some of the ones that actually weren't down today. Maybe those are some of the opportunities we want to focus on. If you look at the top 10 list, you're going to find consumer staples. You're going to find some energy. You're going to find some, seed companies, material stocks. Dow's up there, up 9% today. They're out there. It's just not the growthy stuff. And we can see that with the Magnificent Seven. All of these names were down today. Netflix, which had that great surge higher. Do you see what happened on that chart? There was that initial surge as news of the, merger with Warner Brothers was off the table. Stock spiked up very, very quickly from that moment on, though. It's really started to rotate lower. Another down day today. Microsoft down 0.75%. Amazon and NVIDIA both down about 1.5%. The worst performers today were Tesla, down 3.1%. Meta, which has been, kind of holding its ground, but kind of rotating lower today, down 2.5%. Apple was down about 2% as well. So a rough day for growth. The problem for our benchmarks is that growth is kind of the biggest weight. And so when those names are down, the benchmarks are going to be struggling quite a bit. As a reminder, we're live streaming once again, and it's awesome to be back. I'm seeing some great comments about, going back live. I'm excited to do it too. Miss doing the show live. Happy to do it. There's a vibe that only comes when we're doing the live stream, and I'm happy to do it. I do see some questions coming in through the different platforms. We're live streaming on Facebook, LinkedIn, YouTube, and X. So thank you guys so much if you're watching live. Great to have you here. Please use the comments section on any of those platforms, and I can see it real time here. If you're watching the replay on our YouTube channel, you can use the comments section to ask questions. I've already had a couple really good questions to grab for tomorrow's all mailbag episode. One comment that I did see, the New York Advanced Decline line, bearish, 100% right. And I think that weaker breadth, that's been, again, when you think about what's changed the most in the last 4 weeks, the breadth taking a big rotation lower. I think, certainly one of the biggest shifts that we've seen. And the market could remain strong if mega cap technology, mega cap communications names, those Mag 7 names, if they were stronger, the benchmarks would probably still be flat. But the fact that those are kind of flat to down and a bunch of other things are now going down, there's just nothing left that's really rallying besides energy, which is still not a huge part of the benchmark. That's kind of the struggle that we're in here. The struggle is real. All right, let's get to the heat map and share what we learned today. Again, there's a lot of red here. So on a day like this where the benchmarks are down, on the day like this where the trend overall was lower and the breadth was weaker, shall we focus on some of the areas that were strong? So the default answer is it was probably down. So what was not down? Let's go kind of around the heat map and focus on some of the areas that we're not struggling. Within technology, not much, right? And that is one thing to take away. There have been days when like some tech is up and some tech is down. We've seen big up days and big down days kind of in the same session. There wasn't much that was up, and the stuff that was up today are things that have generally been struggling, like Palo Alto Networks, which has been bouncing off of a low from late February, still kind of in a downtrend pattern, maybe making a new swing high this week. So something to watch. Like Palantir, same thing, bouncing off of the lows. Salesforce.com bouncing off of the lows. HPQ, I mean, this is still a pretty rough chart. So these are charts that are maybe bottoming, but they're just not great charts. I mean, I would not describe any of those as particularly compelling charts at this particular moment. So there's not a lot looking good, and there's a lot of things that are actually looking pretty bad. So the things that are bouncing in that sector today are more of the counter trend moves. Within communication services, it's the more defensive areas like AT&T and Verizon. AT&T has actually pulled back after testing the high from last summer, last fall, right around 29, but maybe bouncing higher. We'll see. So the names rotating higher today are kind of the defensive areas there. Within healthcare, there's actually a bunch of things breaking down. I've grabbed, I think, one of those charts to share with you. So none of these charts in healthcare look particularly strong. I mean, Cardinal Health, it's like, can you find a good chart in healthcare? I probably could. I mean, if the challenge was pick a good chart in every one of the 11 S&P sectors, I bet I could do it. But like in healthcare, like Cardinal Health is still a pretty good chart, right? I mean, it's in an uptrend. The moving averages are in the proper order. And if you think about this chart relative to the rest of the healthcare, it's fantastic. So this is what we would often do with institutional investors and think, all right, you still want to have some exposure to healthcare. You don't want to be completely naked this sector. You want to have a bet of some sort on. So let's just make sure we own the best charts within that sector. And that was a constant effort with some of the portfolio managers that had a larger group of holdings was let's look at each of the sectors and make sure you just own the best charts. And that was a pretty good way to outperform consistently. So Cardinal Health is outperforming year to date, which is kind of rare in the healthcare sector. Still looks pretty strong, making higher highs, recently making a pullback to the 50-day moving average. I don't mind that chart right about now. So I'll leave that one as one of the few healthcare charts still looking remarkably pretty okay. In terms of other things that have worked today, energy, of course, the positive outlier. This is a sector filled with charts that look pretty constructive here. A number of them making new 52-week highs here in the month of March. Of course, that is driven by the strength in crude oil prices, which does not appear to be slowing down anytime soon. Also, the utilities sector. I'm noticing like American Water Works making a new 3-month high. There's not a lot of things on the new 3-month highs list today, for example, but AWK is one of those, up about 3% today. So interesting that utilities one of the better sectors. Materials generally does not look all good, right? Because you have like mining stocks like Freeport-McMoRan kind of testing support at $60, but you also have Mosaic making a new 3-month high. Mosaic today is gapping above the 200-day moving average. We had that rally yesterday, which caught my eye because it was one of the top performers in the S&P yesterday, if I remember right. And I remember looking at this chart and thinking, boy, if we can get above the 200-day moving average, that's pretty good. It happened today. We had another gap higher. It's up 7.6% today. making a new 3-month high where I saw it on the list as well. So momentum is improving as the RSI bounces off of 40 and now pushing above 60. That's a good example of a chart kind of rotating from a bottoming phase. Look at this great bullish divergence here as we're making a low, and then we're making higher lows here in early March, and now rotating higher. So that's a pretty impressive kind of upside rotation for Mosaic. Final thing that I would say is looking pretty interesting is the consumer staples, and this is a sector that's been struggling as of late. You're going to note that a lot of the food companies are down. I would speculate that some of that is tied to stuff I was reading about fertilizers, which apparently also go through the Strait of Hormuz, and also if that supply is threatened, that just means it's going to be more expensive. And so a lot of stocks in that food products group are struggling here today. But some of the names that have been pulling back, like a Philip Morris bouncing higher today, big box retailers like Walmart and Costco kind of bouncing. Costco is right at $1,000, just kind of rotating right around that level. We'll wait and see which way that improves. And ADM making yet another new 52-week high. We talked about that and some of the other agriculture plays on yesterday's show. I think that's it for the heat map. And again, on a day like today, when everything's down, I think it's really helpful, really instructive to just look, as we started to do, look at, continue that process of focusing on the charts that were up. Now, again, this is just one day's action, but when everything's down, whatever didn't go down means something's different, right? There's either a broader sector theme, like we see with energy, maybe it's a company specific theme or a group specific theme. But those are the kind of names that I want to be familiar with and recognize that they might be sort of bucking the overall, in this case, negative trend in the markets here. All right. Here we go. Testing with the audio. 1, 2, 3, 4, 5. How does that work, folks? Guys that are checking the live stream. Testing 1, 2, 3. Sorry about that. I somehow manage to delete my audio sometimes occasionally. There we go. Sorry about that. Hey, I wanted to thank our partners at Seeking Alpha for being supporters of the channel. Sorry for cutting off my own audio. That says that is no comment on Seeking Alpha. That's a comment on Dave trying to do his own producing as we go. One of their great features is they have a portfolio health check. I always describe this as like taking your portfolio to a wellness visit at the doctor, right? And you can see across your portfolio. Forget about the stuff that's fine. Focus on the things that might not be fine. This is one of the tools that they allow you to run on your portfolio. You can import a list of tickers. Again, it's not all the answers. Right? It doesn't tell you everything to do. It's not making a recommendation, but it just helps you identify some potential areas to focus on. And in my time working with institutional money managers, we would always focus our time on that like 5 to 10% of your portfolio where there were some potential issues. Just make sure you're aware of those potential breakdowns. You can find more info about their health check portfolio tool, along with a bunch of other members-only capabilities at marketmisbehavior.com/seeking alpha. If you use that link, you'll get 10% off, and it's a pretty fantastic platform with a lot of cool capabilities. Other thing I want to let you know about is that we have our next live webcast coming up 1 week from today on Thursday, March 19th, 1 p.m. Eastern, 10 a.m. Pacific. The session is going to be called From Model to Market: How Mindful Investors Evaluate Trends. We're going to be talking about my proprietary market trend model. It just turned bearish on the medium-term time frame for the first time since May of 2025. The last time we had a bearish rotation was in February of 2025 as the market was really rotating lower into that April low. So we're going to talk about the different timeframes on the market trend model. We're going to apply it not just to the S&P, but some of the other asset classes. This is an exercise I do often with my Market Misbehavior Premium members, and I'm excited to share it with all of you as well. You can sign up for that free event coming up next Thursday, the 19th at marketmisbehavior.com/model. Man, if I can get through a show without cutting off my own audio, that would be absolutely killer. But so far, I'm not too good. I'm actually really good at eliminating my own audio. So we'll see if I can pull this off for the remainder of the show. All right, let's look at some charts that I've hand selected. We've been talking about. I mean, my sort of gut feeling on this market has been the market looks toppy, and I always try to get away from that water cooler level of discussion, just saying market looks toppy. I mean, what's funny is the market is selling off kind of how I would have expected, but what does it actually mean, right? What on the chart actually defines the toppiness, right? How can we define that in a more meaningful way? The fact that we have a level of support that holds and holds and holds, and then it doesn't, tells you something's different, right? If everything's okay, if conditions haven't changed, and the market's going to be holding support at 6,800. So as the trend goes higher, you keep kind of bumping up your stop. At least this is what I do, right? You take those most recent swing lows and you keep bumping it higher. And as long as we hold the most recent swing low, it tells you things just aren't that bad. That's why things were, kind of not that bad in November of 2025. Sure, the breadth got really bad. Sure, the momentum got a lot weaker, but we really kind of held that October swing low and then we bounced. So it's like, how bearish do you want to be if we're still making higher lows? And I think the problem is it's tougher and tougher to explain the chart as holding its recent low. What we've seen now in the month of March is a break below the most recent swing low in a way that we really haven't seen since the April 2025 market low. We're also seeing the RSI push below 40. The last time that happened was back there in November of last year. That ended up being a pretty decent, buying opportunity, which is one of the many reasons why I'm pretty focused on this kind of general area here. You can see our traffic light would go from neutral orange to bearish red. If we would get below 65.50, that would mean a break below the 200-day moving average, which we've been above since May of last year. That would be a break below the October and November swing lows. And that would be a pretty negative sign. And if that would happen, I think that would sort of validate some of the, negative vibes that many of us have been getting about the weaker breadth conditions. Going back to the Hindenburg Omen flashing all those bearish signals, breakdown below the 200-day, breakdown below 65.50, I think just validates all of that. If you think we've sold off already, wait until we start breaking through the 200-day and not holding it. Wait until we break below 65.50 and don't hold it. That's where people can get even less comfortable. I've mentioned a number of times the breadth has been getting worse and worse. Just to update you on this chart, because we're pretty much showing this every session because I think it's an active one to pay attention to. We're down to almost exactly 50% of the S&P stocks above their 200-day. Again, we're right now what's happening is we are lining up very well with the November low. I was not particularly bullish in November of last year because it looked like it could be a major top, and I saw a lot of weaker conditions. It ended up holding, which was great, and I was more excited than anyone that we're making new highs. But it doesn't mean I don't want to get pretty cautious when we're pulling back and we're showing signs of toppiness. So what happened there, I guess what did not happen is we did not break below 50% of S&P members above their 200-day moving average. We're kind of right exactly there as of today's close. I think going into Friday's session and into next week, that's going to be the question in terms of breadth. If that breaks, there's very few breadth indicators that I could imagine that don't look pretty ugly right now. Maybe the bullish percent index on the Nasdaq 100, which is still okay. But that's not much. Most breadth indicators are pretty bad right about now. Percent of stocks above their 50-day now below a third, now less than 33%, less than 1 in 3 S&P 500 members above their 50-day moving average. That's down from 65% just a couple weeks ago. So we've had about a third of the S&P break their 50-day as the S&P did. These are things that, can happen during pullbacks, but they also can happen during broader declines. And that's the elevated risk that I'm noting right now. Boy, if you want to be entertained by some really weird kind of counterintuitive sentiment action, buckle your seatbelts because here it is, the AAII survey. Assuming that this data is accurate, I'm actually going to validate it as we go. because what happens is there are different ways you can kind of capture this data. I'm getting it directly from the AAII website, and it's pretty much true here. Yeah, let's see, 33. Yeah, it is a glitchy thing. Hold on here. Yeah, so I'm looking at the data. This is a weird glitch. I saw this earlier and I was like, there's no way that the bullishness could go up to 46%. Like, that's crazy. So I'm looking at the AAII website. The number's actually right around here. It's just down slightly. So we're at 32% bullish. The bears are 46%. Oh, I see what happened. These numbers are flipped. So 31.9% is actually the bulls, 46.4% is the bears. So this is flipped upside down. That makes a lot more sense to me because I was looking at this, I'm thinking there's no, boy, life lesson right there as a technical analyst. When the chart looks weird, validate the data. That is my number one suggestion. I mean, when things are kind of normal, you kind of assume it's fine. And there can be random data glitches, but when something looks completely off, for example, the market falling off a cliff and a big spike in bullishness, I remember thinking there's no way that's going to happen. So I'm here in the stock charts office, so I'll grab some guys and we'll get that fixed here. But just so we know, this is the opposite. So 32%, that's the bullish reading, just slightly below last time, but it's 46% bearish, which means we're very close to 50% bearish. You know, the last time we were at 50% bearish, November of 2025. So we're having a lot of similarities to that particular period. I'm going to write this down about getting the AAII data fixed. All right, glad we figured that one out. All right, name exposure index. This also is not updated here today, so I dug into the data beforehand. It's down around 68% from last week. Last week was around 79%. This week we're coming down to 67%. So that's a pretty big drop. That means now the name exposure index, which is a weekly survey of money managers, right? A lot of advisors, mostly based in the U.S., if I remember right, and it's a survey basically asking your exposure to the equity markets, right? What's your allocation to equities? And you can go as high as 200% long or as low as 200% short or anywhere between. And it's down below 70%, which is pretty rare. The last time we actually got down to that level was back here in March of 2025. We ended up remaining below 70% all through March and most of April before finally bouncing higher off of the lows. So name exposure index pulling back quite a bit. So appears the sentiment is actually what I would expect given what's happened in the market in the last week. And I was wondering what the sentiment indicators would do after the news out of Iran and the pressure on oil prices. If there's one thing, I'm not surprised the name exposure index goes down. That makes sense. I'm not surprised the bearishness spiked up to 46%. That makes sense. I am quite surprised that the bullishness remained above 30%. That goes to show that there is a subgroup of voters in the AAII survey that are just always going to be bulled up. And that's okay. As long as we know that, we can start to plan around it. All right, rates are going higher. We talked about that a number of times recently. You know, this is, certainly related in no small part to the events in the Middle East and the upside pressure on oil prices, the perceived upside pressure on other prices. We just haven't really experienced that yet. We do have the monthly PCE data tomorrow, by the way, but that's not going to be reflecting any of this recent stuff. That's going to be from before things really accelerated with Iran. So, so generally, this is the market's direct play on what the expectations are. Rates going higher here, bonds being sold off is basically, and I would argue, at least partly an expression of concern about future inflation, what that means about the Fed and their ability to lower rates, which seems more and more pretty much off the table here, or much, much less than we thought. As we look at some individual names, Lou on YouTube, thank you so much for that kind gesture, which what we call a super chat on YouTube. That's super nice of you, very thoughtful. I appreciate that. Glad you're enjoying the live stream. Glad you're tuning in. I know you've been watching the show for a while, and great to have you here. Thanks for your thoughtful questions over the years as well. All right, let's continue on looking at Dollar General and then a bunch of other stocks, individual names that I've grabbed here today. DG and the next one, I forget what the next ticker is, but these were two that actually triggered an alert. I often during the show say, all right, that's a big move. We have to, set an alert for that. And I literally jot it on a piece of paper. And then afterwards, I go and set all these alerts and make sure they're updated. Sometimes I've already set them. I often forget when I've done something like that. So I just make sure that the alerts are where I need them to be. Two of the alerts fired pretty soon after today's open. So I just want to show you what happened. With Dollar General, I was watching this 140 level because that was the swing low from January. If you look here, and then we kind of traded back down toward that level. And so we're pulling back, we're testing the 50-day. So I immediately look to the left and think, all right, well, as long as we hold 140, like at least buyers are coming in and buying on that dip. It didn't hold. The stock actually gapped down on earnings today. We opened down around 132. The good news is we traded higher in the afternoon. So we ended the day around 136. We're still below that level. So now 140 actually became resistance. So what I often do on a chart like this is draw the big horizontal line. It's called a pivot point. Support becomes resistance. That's now the lower end of this price gap. Regaining 140 would be a really bullish outcome, particularly if buyers have come in on a weaker earnings drop and started to accumulate. But until that would happen, this is the kind of chart I probably avoid because now it's breaking below that trigger level. GEHC is GE Healthcare. This actually triggered because I'd highlighted this level. This is $70. This is support all really going back to like summer of last year. Look at how many times we tested that $70 level and then bounced higher. We kind of traded right back down there again today. So for now, I would assume that support holds until it doesn't. We're oversold as we test that, well-established level of support. We kind of broke back above it, closed above there going into the end of today's session. If that $70 holds, maybe this is a good opportunity to play a counter trend bounce back up to the 200-day would sort of be my initial assessment of the chart before I dug into it a little bit further. But again, this is a stock that gapped lower. That was on their earnings release, which was earlier this month. Look at how that's not true. Earnings were back here. This is a different gap, right? So we had the drop after earnings. We had another rotation hour. It was really more range bound. And then we broke below support, and that broke below the 200-day was an issue. And then look how we just continued to accelerate lower. We're kind of at the last level. And the problem for this chart is if 70 doesn't hold, there's not much left on the chart going down to the April 25 low at 58. It's amazing that we might have to be talking about those April 2025 lows with some of these charts, but that's what's starting to happen. MTD is another name, same sector. This is in the medical equipment group within the healthcare sector. Similar vibe. It broke below the 200-day and continued lower. I thought this was an important feature of this chart. We often talk about candle patterns. This is a bearish engulfing pattern, but look at what happened, right? We went below the 200-day moving average. We opened below. This was earlier this month. We opened lower. We closed right at the 200-day. We opened above it the next day, but closed back below it. That's a two-bar pattern, a two-candle pattern called the bearish engulfing pattern. That basically suggests we're now in a period of weakness. And now we've seen that further distribution. What's so interesting about MTD is we had another bullish engulfing pattern here about a week ago, right? A down day, lower open, higher close. That says the next 1 to 3 bars is more likely higher. It didn't take. We never broke above that day's high. And today, we've actually broken below the lower end of that pattern. So what you have to remember is with candle charts, you actually can use them for short-term stops, for tactical stops. Right? These are not long-term plays. These are more swing trading types of things. But a two-candle pattern basically says the next 1 to 3 bars are probably up. But if we break the lower end of that pattern, all bets are off. All bets are off with the chart of MTD, making a new 3-month low today. Elsewhere, GE Aerospace. This is a name that's down over 5.5% today. It's still an okay chart. And I think what's interesting about this stock is that we're still making higher highs and higher lows. Don't get me wrong. I would much rather it be above all the moving averages and have the moving averages in the proper order. The fact that we're breaking the 21-day, breaking the 50-day, that's not great. The real line in the sand, I would say, would be 290 because that would be the most recent swing low, and the 200-day moving average, kind of similar to that 65.50 level on the S&P. I think that's an important one to watch. But we're rotating lower. The RSI is rotating lower. So on these buyable dips, look how the RSI holds 40. All of a sudden, we're maybe not getting a buyable dip if the price breaks lower, if the RSI breaks lower, kind of right at that point where I think it could be a real issue. GE Aerospace is an example of aerospace and defense names. I mean, talk about an area of the market that's been remarkably lights out positive through the end of February, now completely changing here in the month of March. All right, final charts. Just want to highlight AT&T. This has been a fascinating chart. We kind of retested the summer highs back here this month and really last month. We rallied back up after getting down to around 23. We rallied up to the upper 20s. Kind of the previous highs are in play. We had a number of highs in that $29 level. We're kind of back up to that point. We're pulling back here. Now we're at the 200-day moving average. I feel like we're sort of in this limbo, right? Above 29 is pretty good. Below 26.50, right, which would get below the 200 days, pretty bad. Anything in the middle is kind of neutral. It's kind of right at neutral. This is a stock that yields about 4% dividend yield based on the estimates, so that's not bad. What I also like to do when I see a stock that's kind of chopping around like that, take a glance at the volume. So this is the volume chart of AT&T. The stock's pulled back a little bit. The good news is the accumulation distribution line has been trending higher. That's Mark Chaikin's indicator that looks at the directional volume on up days, up closes versus down closes, and you're seeing it's pretty constructive. Chaikin money flow very close to turning negative. So if we would get a break below the 200-day, if the Chaikin money flow goes below zero, for me, that would be a let's get out of the way and reassess, kind of right at that crucial moment. Hey, let's finish the show on a positive note. Energy stocks still look great. So there was a time not too long ago, 6 to 8 weeks ago, a bunch of charts looked like a VLO, right? Making higher highs, higher lows, moving averages sloping upwards. Energy are kind of the only sector where you're seeing a bunch of these types of charts, but it's a great reminder that when the markets are uncomfortable, when the markets are uncertain, let's focus on the charts that look the best. As I always sign off on the episodes, it's always a good time to own good charts. So let's make sure we own some good charts. We're long on time, but I'm going to take one quick question. Yes, the bearish divergence. I think that was on one of these charts here. Yeah, maybe this one. I think on AT&T, you're probably talking about the bearish divergence, Floyd. For sure. And I think the one issue that I'm seeing with a lot of charts right now, you're not seeing it with like an AT&T, not AT&T. You're not seeing it with like Valero. Necessarily, only because we're overbought right now. So I would not describe that as much of a divergence. A classic divergence for me would be overbought on the first peak and not overbought on the second peak. So as long as we keep making higher highs and keep getting overbought, that's actually a pretty good thing. But I'm seeing a lot more charts that look like this. I mean, here we're making higher closes on weaker momentum, and that's as it's testing its previous highs. So bearish divergences for me aren't a rule. I would never manage a portfolio based purely on bearish divergences, but when I see them on charts like an AT&T, definitely makes me think. Folks, that's a wrap for the show. Thanks so much for tuning in live. Those of you that are doing show, if you're watching the replay on YouTube, welcome and thanks for watching. Take a moment, if you would, drop a question in the comments section of our YouTube channel. We'd appreciate it. We are going to be traveling tomorrow. We're actually going down to Southern California. I'm on the board of a music school. We're doing a board meeting down there and a fundraiser to help raise awareness for the importance of music in our lives. Super deeply important to me, and I hope you find some time this weekend to listen to some music. We will be putting out a show. It'll probably be recorded because it'll be a mailbag episode. I'm just going to have to figure out when I can fit it in with my travel plans, but we are set to be back live this coming Monday. In the meantime, have a great night. And remember, it's always a good time to own good charts. Take care, folks.